Hey, what's up, my friend? So, in today's training, I want to share with you how much money a retail trader can make. Okay, so when I talk about retail trader, basically, it's like traders like me and you, right? We are trading from our computer without any sophisticated softwares. These softwares are usually free or doesn't really cost a lot of money. So this is what I mean by retail trader. So how much can a retail trader make? So first and foremost, let me ask you, how much money do you think a doctor make a year? Well, I'm sure you'll agree, right, that Rayner, it depends on a few things, right? It depends on, where the doctor is working from. Clearly, a doctor who works in, let's say, in Switzerland compared to a doctor working in India, there will be a different pay scale because of the different standard of living. And then a doctor who is, let's say, a brain surgeon compared to another doctor who's just a general practitioner. Again, we have different pay scale. Or a doctor with 20 years experience compared to a doctor that, just graduate. Again, there will be a difference in pay scale. So how much money can a doctor make? Well, there are a few factors to consider. Or what about, let's say starting up an online business? How much money can you make, doing an online business? You have heard, businesses making millions of dollars online, and then there are some struggling and fail. Well, again, depends on a few things. Do you have a product that is in demand? Clearly, things like health supplements, right, are much more in demand compared to teaching your parrot how to talk. Or that's chicken, right? So you can see that there's a demand, right? Supply and demand. Or, how much money or rather, how much volume does your business does, right? The more you sell per day, let's say a business selling 10 units a day compared to another business selling 1,000 units a day. If all else are equals, the one that sells more per day is going to make more money, right? Or what about the price of your products, the margin of your product? All these factors comes into play. So why am I sharing this with you? It's very simple, really, because how much money can you make as a trader isn't definite. There are factors in play as well. And that's why in today's training, right, or rather today's video, I want to share with you what are these factors that you must consider. Number one, the size of your trading account. So this is something that I think intuitively most of you understand, but somehow you neglect this, right? And here's why. If you have let's say $1,000 trading account and you do an average of 10% a year, you would, get about $100 a year. Okay, that's a 10% of $1,000. Now let's say, you trade a larger account. 10% of $100,000, that's about $10,000 a year on average in the long run. And let's say, what if you have $1 million trading account? 10% of it is about $100,000 a year. So you can see that the strategy is the same. The returns, right, in terms of percentage is the same. The only difference is the size of your account. And that determines, right, that has a huge factor, right, to how much potential ka-ching you can make, right, in terms of dollars. So the size of your trading account clearly, right, plays a huge role. So I'm baffled, right, whenever traders say, oh, if you have a profitable trading strategy, man, why don't you keep it to yourself and just trade the markets and then like a vacuum suck every cent out of the markets? Well, it's simple, right, because you need money to make money in this business. If you have a tiny account, like a $50 account, doesn't matter what trading strategy that you use, right, there's only so much money you can make with a $50, $100, or $500 account. Small account, small returns. Big account, bigger returns in terms of dollars. Of course, you can take on more risk, and risk blowing up your trading account, blah, blah, blah. But that, we are talking about if all else is equal, right, are equal, right? Size of your account matters. Number two, frequency of your trades. Okay, so this is something that a lot of traders, they don't get it. So I want to explain this as simply as possible. Imagine, right, that you have a trading strategy that has a 50% winning rate and an average of a 1 to 2 risk-reward ratio. And let's say you risk 1% of your account on each trade, okay? Let's say you have 10 trades per year. So how much would you expect to make, after 1 year? So let's keep things simple. Let's say you do 10 trades a year. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Okay, let's say 50% winning rate. Let's say your first 5 trades are winners. Let's keep things simple. These are the winners, and then these are the losing trades. So you have an average of a 1 to 2 risk-reward ratio, and you risk 1% on each trade. So if you have 5 winning trades, risking 1% on each trade, and you have an average of a 1 to 2 risk-reward ratio, you will make a gain of about 10%, right, for these winners here. For your losers, you'll be down negative 5%. Okay, so in total, you can see that you will be up, right, positive 5% after 10 trades. Okay, so let's say if you have doing about 10 trades per year, risking 1% on each trade, and with a 50% winning rate and a 1 to 2 risk-reward ratio, you would expect to make an average of 5% a year. Now, let me ask you, what if you can do 100 trades a year instead of just 10 trades? Then now you won't be making 5% a year. Now your 5% would be 50% a year. Again, all else are equals, right? Same size of your trading account, same strategy, same risk per trade. But the only difference is your frequency of trades. If all else are equals, the more trading opportunities that you have, right, the more money you can make. And this is pretty much falls into the realm of high frequency traders, where they trade so many times a day, and that's how they extract all these little edges, right, in the markets. High frequency trading. Okay, so that's second thing you must consider: frequency of your trades. The third thing is this: your risk per trade. So again, let's use that same example: 50% winning rate strategy, a 1-to-2 risk reward ratio. But this time around, you risk 10% of your account on each trade. So again, 10 trades: 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Let's say your first 5 are winners, and your second batch, right, are losers. So winners, right? So again, you have 5 winners, right? Each time you win, you make an average of a 1-to-2 risk reward ratio. Okay, so 10% risk on each trade. So each trade that you win, you make 20%. 20% multiplied by 5 over here is a gain of 100% for your winners. And because of your losers, you have 5 losers, 10% risk on each trade, you lose negative 50%. So at the end, right, you are positive 50% in this example. Okay, so again, the key thing that I'm trying to share over here is that, again, the more you risk, right, in terms of your percentage of your account, the more money you can potentially make. However, there's a downside to this, and the downside to this is your drawdown increases as well. So generally, the more you risk, right, the more potential loss you can face, because you can see that right now your losses here are negative 50%, whereas the earlier example is about 5%. So again, the more you risk in terms of percentage, the more you can potentially lose as well. And one final thing to share with you is that average return, right, is misleading. So for example, let me give you an example. So this is actually a screenshot of one of my portfolio account that I trade. Right, you can see over here, this strategy in the long run, it does about 20% a year. Okay, but you can see that over here, the past 1 year, it has been up 10%. So you can see that it's actually below the 20% historical average, right, that I would expect from this strategy. And here's another account that I trade. This one here, historically, it does about 30% a year. And for the past 1 year, this one over here has been up about 97%, almost 97%. So again, it's more than the historical average. So what's the key thing that I'm trying to share over here? And it's quite simple, actually, is that annual return, let's say you have a strategy that makes an average of 20% a year. You shouldn't expect, right, for the next 10 years, is 20%, 20%, 20%, 20%, 20% until year 10. It doesn't happen that way. It doesn't work that way. In fact, what would happen is that year 1, maybe you're up, let's say 10%. Year 2, you might be down 5%. Year 3 is break even. Year 4, you're up 50%. Year 5, you might be down, let's say, another 2%. Year 6, you're up, let's say, 70%. Then year 7, yada yada. The returns fluctuate, right, from a year to year basis. Some year you might be down 10, 20%. You never know. And in the long run, when you average out all this return, right, that's how you get your 20% average return. And that's the truth about trading. So don't expect, how much someone say, you can make from trading, let's say 20% a year, and you think, oh man, this year I'm going to make 20% for sure, right? Or 21% or 19%. No, it's usually pretty far away from the average. That's why we call it variance. Okay, so bear this in mind. This is important. So as a quick recap, right, how much money can a retail trader make? And the truth is that it depends on a number of factors, like how much money a doctor can make, how much money an online business can make, how much money trading can make. Number 1, depends on the size of your account. Number 2, the frequency of your trades. Number 3, your risk per trade. And finally, number 4, average returns, right, can be misleading. All right, so with that said, right, I hope you got some value out of this training. It opened up your mind, right, to see trading in a slightly different light. And with that said, I wish you good luck and good trading. I will talk to you soon.